For this video tutorial, I want to go over a sample Form 1065 partnership return for the 2022 tax year. And the example fact pattern we're going to be working with is a lawn care and landscaping business. So I've got a couple of elements in front of us and exhibits that we want to go through. So I'll go through all those first and then we'll come back to these slides. So 2 slides, right? First one is covering all the information that we'll go through. And then the second piece I've got here is the financial statements for the company. So we have our fake lawn care business. We have a profit and loss here on the left-hand side, and then the company's balance sheet at the end of the year. We've also got a reconciliation of some book-to-tax differences that we'll talk about, and then a capital roll forward for the partners in the LLC. And then lastly, we have the actual tax return itself. So this is, again, a 1065 partnership return for 2022, and we're working with our lawn care business. All right, so let me go back to the slides. I'm going to cover everything that I'm going to address, and then we'll get into the details of the fact pattern and then start looking at the financials and the return itself. So what we're going to cover, obviously the Form 1065 prep itself, right? So we'll go into the financial statements, so the profit and loss, the balance sheet, and capital roll forward for the company. Now the Form 1065 obviously has a lot of pieces, right? So pages 1 through 5 are kind of the standard set within the return. We'll cover all those. Form 1125 is the cost of goods sold form that's included with the return. 4562 covers depreciation, right? So we have some bonus depreciation for the year, and so all that's going to be recorded there. Schedules B1. So B1 is a disclosure of the owners in the company, right, that own a certain percentage or greater, right, depending on the threshold. So we'll go into that. Schedule K1, very important, right? Every partner gets a K1 that shows their allocation of these items. So we'll go over those. And then QBI information under Section 199 Cap A. Second piece there, or moving on from the return itself, we'll talk about separately stated items on the K1. This is a very, very important concept with partnerships and S-corps, right? You have separately stated items that cannot be aggregated as part of the ordinary trade or business income. So things like dividends and interest, non-deductible expenses, credits, and so on. Talk about bonus depreciation. So for 2022, we still get up to 100% bonus depreciation on eligible assets. In 2023 and going forward, there are reduced rates. So the Tax Cuts and Jobs Act has sunsetting provisions that basically say, okay, bonus depreciation still on the table, but you get reduced rates in those following years. Talking about some tax credits. So the 5884, the work opportunity tax credit, we'll talk about that, see how that's calculated and passed on to the partners. And Form 4136, credit for federal taxes paid on fuels. Very important in these types of sectors because we obviously spend a lot of money on gasoline and fuel that's used for off-highway use. And so you might be eligible for a credit there. We'll talk about K2 and K3 filing exceptions and what kind of statements need to be attached to the K1. And then also what kind of disclosures have to be made on Schedule K of the Form 1065. And always important to talk about basis issues for partners, right? So we'll look at the basis worksheets and calculations for the partners, talk about their capital accounts, the debt being added to their basis under 704D. So we'll go into those worksheets. And then lastly, we'll cover the de minimis safe harbor elections. So when you have small equipment and property purchases, although they might be a long-term asset that you could arguably capitalize and depreciate, under these tangible property regulations, you can just expense them currently and you don't have to worry about capitalizing and depreciating, but you need to include an election statement under the safe harbor, and so we're going to look at that as well. All right, so let's go on to the next slide where we'll look at the fact pattern. And then again, we're going to, after we go through all these details, jump into the returns, the worksheets. We might come back and forth to this to reference this, but I want to go through it first just so everybody has an idea of kind of what we're working with this company. So the lawn care business, we have John Smith and Jane Doe. They're friends, so they decide to partner up and open a landscaping and lawncare business in Florida, so they set up a Florida LLC. Now, they're each going to own 50%, and they're each going to actively participate in the business, right? So they're not just passive investors, right? They're both going to be involved in running the company. Under their agreement, neither partner is going to be paid a guaranteed payment for the first 2 years, right? And that's fine. So guaranteed payments simply mean it's going to be a set salary component for the owners. No, right? So they're just going to have their allocations of profits, if any, and then distributions if there are any cash being paid out. But in this case, they're each going to put in $10,000 of cash to get the company up and running, and they're not going to take any distributions during the 2022 year. Now, the LLC purchased a bunch of equipment, right? They need equipment to get going. So they've got 2 mowers, they bought a truck, and they bought a trailer for the truck to move the mowers around. Now, the mowers and the truck, they financed these purchases. Both owners signed a personal guarantee with the finance company for all the notes. So those are going to be recourse debts, meaning the LLC isn't going to shield them, right? So if they default on the notes, the finance company can come back to them personally and collect on the debt. Not uncommon, right? Companies do this all the time. So the LLC is going to be eligible to claim 100% bonus depreciation on the equipment. That's great, right? So we get to write it all off in the first year. Now, John also decided that he was going to open a brokerage account under the LLC name and tax ID. Might seem a bit bizarre, but it's not quite that uncommon now, right? You have good interest rates. You can reinvest the cash in other types of assets, stocks, bonds, crypto. And so they opened the account in the company name. And so during the year, they received some interest income and dividends, which are going to be separately stated K1 items, right? And so we'll go into that in more detail later. Now, in addition to all that, Jane decided to hire a part-time admin person through Florida's Work Opportunity Tax Credit Program, right? So the reason why this is significant is because if you hire individuals through this program, you are eligible generally for a federal tax credit on the wages paid to that person. Right, and so this individual worked 450 hours during the year. They were paid $7,200 in gross wages. And so on the form 5884, we calculate the work opportunity tax credit, and then that credit is passed on to the partners. And so we'll look at that in more detail, see how that's reported on the K1 as well. Now, the LLC obviously needs to keep good books and records, so they track not only their fuel costs, but they actually track the number of gallons purchased for the mowers, right? Now, why is this important? Well, off-highway use of gasoline or other kinds of fuel, you might be eligible for a federal tax credit on the fuel. And so they bought 4,206 gallons of non-dyed fuel. And the reason why that's important, of course, is if it has the dye in it, it's generally exempt from the federal taxes, whereas the non-dyed fuel, so the regular gasoline that you would put in your car, that does include the federal tax component. So if you did that, you might be able to get a federal tax refund on the fuel purchases, and that's done on filing Form 4136. Now, again, that's also information that's passed on to the partners via the K1, so we'll look at that in more detail as well. And then lastly here, the LLC purchased a number of small tools and equipment, which it deducted currently rather than capitalizing them. And so what we're going to do is, because they fall under that safe harbor threshold, we're going to write them off in the current period. So in other words, we're just going to expense them, and we're going to file an election to claim the de minimis safe harbor rule for those purposes. All right, so now that we've covered that, let's start looking at the financial statements themselves, and then we'll get into the tax return. All right, so here we have the financial statements for the company. Go through these really quickly, and then we'll start looking at the return. So the profit and loss and balance sheet here, profit and loss on the left-hand side, we have revenue, right? So these are the sales coming from our customers for the various services, mowing the lawns, landscaping maintenance, and then sales of actual products, right? So plants, trees, sod, mulch, and so on. Cost of goods sold, so these are the direct costs allocated to the revenues, labor, materials and supplies, fuel costs for the mowers, and so on. And then down in the expenses section, we have all the other kind of indirect costs in running the business, right? So admin, staff wages, insurance, fuel costs for the trucks. What we do have here, depreciation expense. So if we just quickly look at the balance sheet, here were the fixed asset purchases. So the two mowers, the trucks and the trailers there. So the total all-in purchase price of all of those assets was $73,500. And because we're taking 100% bonus depreciation on everything, we've recorded accumulated depreciation of the same amount, and then that is the depreciation expense for the year. Now, these financial statements were prepared basically using tax basis accounting. So if you're under US GAAP accounting, let's say, you wouldn't have bonus depreciation. So you might have accumulated depreciation of a smaller amount, and then we would have a book tax adjustment on the return for the variance. In this case, they don't need to prepare GAAP financial statements, so they just wanted it to match their tax return. So that's why the depreciation expense that we see on these financial statements is going to match what we have on the return. Now, on the bottom here, we have our other income and loss, and so these are those separately stated items, right? So dividends, interest income, we're going to see that those are separately stated on the Schedule K1, and we do have some notes here on the left-hand side that cover some of these issues, right? So partnership taxation, if you're looking at 702A7, you'll see that these are types of income that have to be separately stated, right? So they can't be included in ordinary trade or business income. The de minimis safe harbor election will apply it to these small tools and equipment, repairs and maintenance purchases. The work opportunity tax credit is going to apply to these wages, right? So the $7,000 and change dollars paid to that admin person are buried within there. And so what we'll see is that the work opportunity credit is going to factor that in, but it's also going to be an adjustment, a book tax adjustment for a piece of that wage component. Now on the right-hand side, relatively straightforward balance sheet, right? Cash accounts, the balance in the brokerage account, security deposits. We have the fixed assets there, the accumulated depreciation. Down here in the liabilities and equity section, we've got accounts payable, credit cards, and then we see here the note balances, right? So again, remember, we finance the purchases of not only the two tractors, but also finance the F-250, right? So the truck we purchased, we finance. So those are the balances at the end of the year. And then in the equity section, we have capital contributions for John and Jane. Remember, they put in $10,000 each. And then there is the current year book loss of $56,860. Now you notice most of that, huge, all of that really is being driven by the depreciation, right? Depreciation right off of the year, bonus is $73,500. So that on paper wipes out all their profits for the period. And that is generally the benefit of bonus depreciation, right? We see the same issue with real estate companies. Might be cash flow positive, but depreciation does wonders with writing off all the profits, so that for tax purposes you end up taking a loss for the year. Okay, so let's have a look now at the tax return, and then we'll start kind of piecing these the components together. So the 1065, best place to start with the beginning here is populating all the information on the top, right? So this is the easy stuff. So the name of the partnership, right? The tax ID number, the date the business was started. Generally, this is just the formation date of the LLC, right? So we formed the entity on January 18th, 2022. So that's our business start date. Address, principal business activity, product and service, and business code number. You can find all this information in the instructions to the form, right? At the very bottom, they have a list of all the business activity codes. Find the one that's most closely resembles yours, right? Sometimes you might not find it exactly, but just find the one that really closely resembles your business, and then you should be fine. So items G and H, right? So this is an initial return, meaning it's the very first Form 1065 we are filing, right? And that's because it was set up in 2022. So obviously we wouldn't be filing anything for 2021 in a prior year. We are under the accrual method. And then item I asks us how many partners there were during the year. So the numbers of Schedule K1. So we have a 2-person LLC, 2-person partnership. So we're going to have 2 K1s. Now, before we get into page 1 information, I want to start with Schedule B. So Schedule B is a good place to kind of start because It contains a lot of yes/no questions and other information, and depending on how you answer these questions will drive additional forms or schedules that you need to complete, or things that you just can either omit or ignore, right? So at the top here, what type of entity we have? Domestic LLC. So domestic meaning, was it an entity formed in the U.S.? Yes, it's a Florida LLC, so we have a domestic LLC. And then question 2B is asking, did any individual own directly or indirectly 50% or more of the company? And our answer is yes, right? So we have to disclose that John Smith and Jane Doe each own 50% of the company, so we're going to attach a B1 that's going to include that additional information on them. Now, the rest of the questions here, all no's for us, right? You could answer, arguably, I think you could answer maybe question 4, yes, right? So, did the partnership satisfy all 4 of the following conditions? In our case, what we'll see is that the total receipts for the year are under $250,000 and the assets are under $1 million. However, what I see with some tax prep software is if you answer yes, it doesn't let you or doesn't allow you to complete schedules L, M1, and M2. And in our case, if we look at, this is what I'm talking about, if we look at Schedule L for the balance sheet, we are going to complete this, even though we might be excluded from it. And that's a best practice that I have. I like to complete all of the schedules here, even though you might be exempt. And I just think that provides more information for not only the owners of the business, but the partners, and it helps provide a more accurate return. So the rest of those are no. The one things that we definitely had to do, item 16, so 1099s. We did have to file 1099s because we made payments to independent contractors in excess of $600 for their non-employee compensation. And so we did 1099 NECs, and we marked yes for both, right? We needed to do those, and we did file them, so those are marked yes. The rest of this, again, all no. For item 30, right, electing out of the partnership, a centralized partnership audit regime, you could do this, right? So I've got some other videos on this, which I'll put some links below. But in this case, they decided to not elect out. So what we've done is answer no, and then we put John's information down here as the partnership representative. All right. So I think next good place to start would be the balance sheet for the company. So we can do balance sheet. Then you can go to page 1. A lot of these can kind of go, frankly, when we work on returns, we kind of do them simultaneously, right? Enter information, as we just work through the financial statements. But, you can start with the balance sheet per books here. I think it's maybe a good, helpful starting place. So the balance sheet per books should match the balance sheet per books, right? That sounds stupid and obvious, but what they wanted to see on Schedule L is a reconciliation or a matching of what we have here versus what's being reported on the tax return. So on the tax return, report the cash balances up here on line 1. We have other current assets, so that's the security deposit, and then the amount of assets in the brokerage account. The accounts payable down there, so AP plus the credit cards, payroll liabilities, that's fine. And then the long-term debts reported on 19B, so mortgages, notes, bonds payable that have maturities of 1 year or more, right? So if we did 5, 6, 7-year financing on those asset purchases, that's fair to put that in the long-term debt section. Now, the buildings and other depreciable assets, we'll have a closer look at the depreciation schedule later in the 4562, but you can see here this is also a matching, right? So 73,500 was the total gross asset value of the purchases, and we are recording a full amount of accumulated depreciation because we are taking bonus depreciation for 100%, right? And so that's why we see that figure there. All right, now let's go to page 1 of the return, and we'll start entering some of the information on the revenue expenses for ordinary trader business. So I think a good place to kind of review both of these is the book tax rec and then page 1 itself. So page 1 is where we report just the trader business income and expense. Right, so as it notes up here in the caution section, caution include only trader business income and expenses on lines 1A through 22. This is the issue with the separately stated items. So with partnerships and S-corps, Trader business income goes on page 1. Any other separately stated items that have to be separately stated under the tax code do not get included here. They are separately stated on the K1. So what's an example? Well, as I highlighted down here on the partnership financial statements, dividends, interest income, these pass-through items, they are separately stated as required by the tax code. So when we look at the page 1 of the 1065, you're not going to see the dividends or interest income being reported here, right? It's going to be separately stated on the K1. So when we look at Schedule K, line 1, that is the amount flowing from page 1. So the minus 54,030, that's coming from page 1 of the 1065. The rest of these items are those separately stated items, right? So we can see here things like rental income, guaranteed payments, dividends, capital gains, etc. All of this stuff is not included necessarily in page 1. It's separately stated here on Schedule K. So the helpfulness of this reconciliation, what I've done here is I have the left-hand column shows the book income and expense as it matches the financial statements. So minus 56,860, right? That's the net income or loss, so net loss per books. And then in this column, I have what should be showing up on page 1 of the Form 1065. And then this column shows the pieces here that would otherwise be reported on page 4 or some other adjustment. So what we can see here on page 1, we've got obviously the receipts, the cost of goods sold, the various expenses. But the changes that we're leaving out are the dividends and interest income, so that's not going on page 1. And then with respect to the admin staff wages, notice here the amount per books is $30,500. The amount that's going to page 1 is only $27,600. So the variance is $2,880. The reason why that's happening, and we'll cover this in more detail later, is when you take a credit for the work opportunity tax credit, you can't get a deduction for the same amount and the credit, right? So there's no double dipping. You can't take the best of both worlds, so to speak. So if you claim the credit on the 5884, the work opportunity tax credit, you have to reduce the deductible piece by the amount of that credit. And so again, I'll cover that in more detail when we get to the work opportunity tax credit. But this is ultimately what we need to see on page 1 of the 1065. So the net income or loss per page 1 is going to be 54,030, right? So if I go back up to page 1, we are going to see that we're going to get to our net amount of 54,030, and so that's the varying expenses here, right? So again, we got our gross receipts, cost of goods sold, salaries or wages paid to the non-partner employees, right? Repairs and maintenance expense, we see the depreciation there, right? And then any other kind of trade or business expenses that are not included on lines 9 through 19 get reported on line 20 as other deductions, and then just attach a statement showing more detail. All right. Okay, so before I get into Schedule K, I want to touch on the depreciation expense for those fixed asset purchases. All right, let me scroll through here to the depreciation section. Okay. All right, so depreciation and amortization on the 4562. So this form is really broken out into kind of 2 pages, right? So page 1 is part 1s, 2 and 3. Part 1 is if you're deducting things under section 179. Now that might be an option if you can't use bonus depreciation, but in our case we can. So the relevant pieces for us are going to be in part 2. So this is special depreciation allowance, which is another word for bonus depreciation in this context. But what's unique about our situation is we do have bonus depreciation, but you only report bonus depreciation here for qualified property that is not listed property, right? And in our cases, if we look at our balance sheet here, we have a couple of kinds of property that are being depreciated, right? We have the mowers, right, which are being used obviously to mow the lawn, to do the landscaping. But then we have a vehicle, an F-250, which is a passenger vehicle for most parts, and then the trailer. Now, the reason why this is important is because passenger automobiles are basically considered listed property, right, for the most part. There are some kind of unique exclusions. But the truck is going to be eligible for 100% bonus depreciation, but it still counts as listed property when we go through the motions of deducting it and reporting it on the return. So in Part 5 here, we have listed property, and these are automobiles, other types of vehicles, aircraft, and so on. And so when we depreciate the listed property, it has to be reported here in Part 5, but the mowers and the trailer, that can just be lumped in to Part 2 under the bonus depreciation. So when we look at our depreciation schedule, write it all off 100% for 2022, put the depreciation amount there, but the listed property piece has to be reported in Part 5. So in Part 5, we have on line 26, property used more than 50% in qualified business use. Now this percentage is really important. So this vehicle truly has no personal use. So the owners don't use it for non-work reasons whatsoever. So it's 100% being used for the business. So it's always got the trailer hooked up to it. It's hauling around the mowers. They're not driving it around for short-term personal errands. And so that's significant because that means we can actually deduct 100% of the cost basis as our depreciation deduction, which is reported here in line 25. Now, because we have listed property, we also have to answer these questions up here in line 24A and B. So we have evidence to support business use. We also have written evidence of the documented business use. And then in section B, because the vehicles are being used by the owners that are actively participating in the business, we have to provide more information on the total amount of business miles driven, commuting miles, and personal miles. In our case, all the miles driven, so let's say we drove 52,600 miles during the year. All of it was business, so we don't have any commuting or personal. Right, that's fine. We also check off these boxes here, lines 34 through 36. So no, the vehicle was not available for personal use outside of business hours. And the vehicle was being used by the owners, right, because they are actively involved in participating in running the business. So they're out there helping on the job sites. And there is a vehicle available for personal use for the owners beyond this one, right? Okay, so that's the 4562. And again, the total, right, depreciation expense that we have, line 22, that is the amount that's being passed up to page 1 of the 1065 on line 16A, right? So there's the depreciation expense. It's a full 100% bonus depreciation amount. And so that's what we've got on the 1065. All right, so after the depreciation, let's move on to the Schedule K items. So when we look at Schedule K, these are the distributive share items that are eventually going to be allocated to the partners, right, according to whatever the allocation provisions are in their partnership agreement. Normally it's just pro rata based on their ownership percentage. But think of Schedule K on the 1065, so Part 4, or Page 4 rather, is kind of the total amount. So these are the total amounts that are eventually going to be passed on to the partners on their individual K1. So line 1 there, that's the ordinary loss coming through from page 1. So that's going to be allocated to the partners. And then all these other separately stated items below. So again, we have the interest income, that was $10. The dividend income paid out. Ordinary dividends were $40. And then of that, the portion that is qualified is also $40. Right? And that's important because when we do our qualified dividend and capital gains tax worksheets for the Form 1040s, qualified dividends are subject to a lower tax rate, right, versus if it was non-qualified. Now moving on down here, the self-employment section, so net earnings from self-employment, notice how that just matches the line 1 amount. So these are deemed to be self-employed earnings because when partners actively participate in the business, the amount of line 1, ordinary income or loss, being passed on to them is self-employed earnings. Now the 14C amount, gross non-farm income, this is often reported because when we compute our self-employment tax using Schedule SE on the Form 1040, there are various methods you can use, right? So there are self-employed calculations, there are gross non-farm or farm type calculations, and in order to pick whichever one you want and accurately do the alternative, you need to know the amount of gross non-farm income being allocated to you. In our case, all of it is non-farm income, right? We don't have a farming business. So that's all gross non-farm income. Now the credit section, this is where it gets a little tricky. Now I think it's a good time to shift over to the work opportunity tax credit. But on lines 15F, what we're reporting here is the amount of the work opportunity tax credit that we're claiming on the 5884. So if I skip through to that schedule here. Okay, so work opportunity tax credit. Won't go into too much detail on how this credit, how you qualify for the credit. I do have other videos that cover this issue, so I'll put the links to that below. But in short, the way this works is if you hire somebody that's an employee at your organization and they work a certain number of hours during the year, you can take a tax credit, which is a dollar-for-dollar reduction in your tax liability for a percentage of the wages paid to that person. So in our case, we had $7,200 of wages paid to an employee that worked 450 hours for us, right, under this program, right? You can't just decide that you qualify for this. You have to go through the appropriate channels wherever where the state you live and work in, right, wherever your business is. So our employee had 450 hours. They are qualified first year wages, so their wages are being reported on line 1B, and the credit percentage is 40%. So when we multiply 40% by 7,200, we got our $2,880 credit there. So this is the credit that is being passed up to Schedule K, right? Again, it's in the credit section, so line 15F, other credits. We'll attach a statement 16 that says this is a work opportunity tax credit on the 5884, and it's for $2,880. Now remember, when we looked at the financial statements, we had an adjustment to our salaries expense for the credit amount. Right, so the amount that we actually paid per books is $30,500, but the amount that we're deducting on page 1 of the return is reduced. Right, it's only $27,620, and that's because, again, if we're going to claim a credit for work opportunity tax credits, we can't also deduct the same amount. So the IRS makes us adjust the deductible amount by the amount of credit. So on our page 1, we report a lower amount of the deductible expense, but then we also have a tax credit on the Schedule K for the $2,880, right? Now, if you're asking, okay, well, what's the whole point of that? Well, if you do the math on this, a tax credit is generally much more preferable than a tax deduction. So by eliminating the tax deduction of $2,880, is not a big deal if we can actually claim a $2,880 tax credit. Now, the adjustment on page 1 is then reported as a non-deductible expense on line 18C. So that's why we have an 18C amount for an equal amount of the work opportunity tax credit item. All right. Let's now have a look at schedules M1 and M2. So these are relatively straightforward, but very important to complete them. So M1 is a reconciliation of our book income or loss with the amount of taxable income or loss on the tax return. So the amount that we see on line 1, net income or loss per books, the minus $56,860, this ties back to our financial statements, right? So if we look at our partnership financial statements here, the bottom line net income or loss per books is that $56,860, right? And that makes sense, right? So that is kind of our starting point. And then on lines 2 through 8, we have any book tax adjustments to get back to what our taxable income or loss per the return should be. Notice here, relatively straightforward, right? We only have one book tax adjustment, and that is an add back of the non-deductible expense attributed to the work opportunity tax credit, right? So in line 4 here, expenses that were recorded on books that are not included on schedules K, lines 1 through 13D and 21. Right, so what we're saying is we had $2,880 of expense kind of buried in here, but we have to add that back so we have a lower loss amount, and that's because we're claiming a tax credit elsewhere on the Schedule K1, right? In Schedule M2, this is a reconciliation or a roll forward of the partner capital accounts. So capital contributed, it was cash, $20,000. Remember, that was $10,000 from John, $10,000 from Jane. And then our net income or loss per books is $56,860. So our ending capital accounts is going to be $36,860. So that's reported here on line 9. We have the same reported up here on line 21. And that also reconciles with the equity here on our financial statement. So when we look at our book, balance sheet, and profit and loss, we have minus 36,860. So that's an aggregate of the net income allocation and then the capital contributions from John and Jane. All right. So that covers Schedule L, M1, M2. Let's now move on to the federal fuel tax credit. Because I think this is also a very, very important element for certainly this fact pattern. So Form 4136 is where we report the federal fuel tax credit. Now, what you see immediately up here is we have our software prepared this for us, and they put this highlighted element up here. For reference purposes only, do not file with this return. When you have a partnership return claiming this credit, the credit, all of the elements have to be passed on to the partners on their Schedule K1s, and they file a Form 4136 with their tax return. Now, in contrast, if we were filing this for an S Corp, or if we were filing this for a C Corp, the Form 4136 would be filed with that return, and the credit would be claimed at the entity level. Because we have a partnership here, we're not claiming the credit and getting a refund at the entity level. All of this information is passed on to the partners, and then they would have to claim the credit themselves. So the pro forma Form 4136 here is really just for illustration purposes for the return. And so what we report here is we're working in the non-taxable use of gasoline section. We have off-highway business use. The reimbursement rate is 0.183 cents per gallon. And we purchased 4,206 gallons during the year that were used on those mowers. So the credit amount is $770 US. Now, where does this get reported? Well, it's a separately stated item, but what's a bit tricky about these items is you'll notice it's not reported anywhere here on Schedule K in some of these line items, right? So it's not reported here as a credit on line 15. Right? We just had the work opportunity tax credit. It's buried in the other information section. So when we look at other information, line 20C, other items and amounts, and attach a statement, this is where we're going to include all of those details. So if I start to look at the Schedule K1, and you'll be able to see where this information shows up. Okay, so let's start looking at the K1 for John Smith, right? So this is John's K1. He gets a 50% allocation of all the items. So some basic stuff on John, right? So the K1 has the partnership EIN, name and address, and then his information in here, Part 2, his Social Security number, name and address. He's an LLC member manager. He's a domestic partner. That's all fine. Beginning and ending ownership percentages, just 50%. His entity type is individual, right? So all this looks good. I'll come back to these pieces in a little more detail later, right? The allocation of liabilities and the capital account roll forward. Now, with respect to the federal fuel tax credit, the amounts are reported, again, in line 20, right? So line 20, we have other information, a number of various codes here. So 20A is just the investment income, so that's the dividends and interest. 20C is where we report this information on the federal fuel tax credit. Now, 20C is $385 for him, right? Remember, the amount of the credit was $770, was it? So if we go back to the 4136, we can see the amount of the credit, $770 US. That's going to be split 50% to John, 50% to Jane. And so that's what's happening on John's K1 here. He has a line 20C amount for 50% of 770, which is 385. Then in the supplemental information, we have some other pieces, right? So the 1065 K1 codes, line 20C, code C, fuel tax credit information, form 4136. And then in addition to that, we've provided more information down here in order for him to complete his own Form 4136. So line 20C, fuel tax credit information, Form 4136. We have non-taxable use of gasoline. Type of use is off-highway business use. We have the rate, the number of gallons that are allocated to John. Remember, the total was the 4206. John gets 50% of the allocable gallons. So he has 2,103 gallons that he can claim on his Form 4136. And then the credit that he's going to get, if he does it correctly, is going to be $385. Now, yeah, this is very often overlooked, frankly, right? So a lot of these credits and things that happen at the partnership level, all of this information has to be separately stated and provided to the partners because the partnership itself cannot claim these things. It can pass on the information, but it can't claim them. So very important that all this is provided to the shareholders, the partners, right? This is a partnership. Okay, so back to the K1s. So the K1s, we've gone over part 1 and part 2. So sections KL. K is partner's allocation of the share liabilities, right? So in the partnership context, remember, let me go back to Schedule L really quickly here. Talk about the balance sheet a bit. Okay, so the balance sheet here, in the liability section, remember we have accounts payable, and then we have line 19B for mortgages, notes, bonds payable. So those are the notes, the balances owed on the truck and the tractors. So we have 1506 in AP, and then 61,835 in long-term debt. Now, remember, with the long-term debt, the owners had to sign a personal guarantee to get the financing. Very common. Right? Companies aren't going to just loan a newly formed LLC with no operating history money unless they get some kind of personal guarantee from the owners. And so that's what they did. Now, the reason why that's important is because when we look at the Schedule K1s, we need to carefully kind of bifurcate the character of the debt, right? So we have non-recourse debts. Those are those other little liabilities and credit cards that there were no personal guarantees for. Qualified non-recourse financing applies to financing for real estate purchases. Generally, that's where you see those amounts. And then recourse debt are debts of the partnership that the partners are personally liable for, right? And that's the case here. So John is being allocated 50% of those debts, and these are the amounts that he's personally liable for, and these are the amounts that there is no recourse, so he's not necessarily personally liable for them. There's always a chance that those creditors can come after him, but when we try to separate them, we try to characterize it at the time that the debt was incurred, right? Now, the reason why that's going to be important when we look at it later is because these amounts impact John's tax basis in the partnership units. Now, item L, capital account roll forward, beginning of the year is 0, right? And that's because the company obviously didn't exist last year. Capital contributed during the year, $10,000 in cash. His allocation of the current year book income or loss, $28,430. It's generally a good idea to have a reconciliation in the supplemental statements that show how we arrived at that, right? So the $28,430 in losses, this is how we got there, right? So he has an allocation of ordinary income loss, $27,015. Interest income, dividends income, and then there's a non-deductible expense allocation of $1,440. So that's how we arrived at that item L amount. And then the ending capital account down there is $18,430 in the negative. Now, often what I hear is, oh, wow, they have a negative capital account. Does that mean that now they have some kind of taxable inclusion? What's going on here? No, not necessarily the case. And with a partnership, that's because, remember, debts are added to your basis, right? So a partner's basis, aggregate basis in a partnership is a combination of their ending capital account plus their allocation of the partnership share of liabilities. And this is what we'll see when we look at the partnership basis worksheets, right? So just some last items to touch on the Part 3 allocation of the items. So we'll see here's 15J, that's the credit, the work opportunity tax credit for the partner. 18C, the non-deductible expenses, so the $1,440 adjustment, because again, remember the tax credit means you can't deduct the same amounts. Now, if we go on to the basis worksheets, okay, so this is the K3 statement. I want to come back to this after the basis worksheets. So QBI, qualified business income, so this is section 199 cap A. So if you have a qualified trade or business, whether it's a partnership or an S corp or even a disregarded entity, you might be able to get a 20% QBI tax deduction on amounts passed through to you. So this QBI statement shows those amounts that John needs to consider when he's doing his QBI deduction calculation on his 1040. So the basic amounts that we see here, right? The allocation of ordinary income or loss passing through, and then his share of the W-2 wages. So that includes wages that are part of cost of goods sold, plus the other items that are not part of cost of goods sold. And then his allocation of the unadjusted basis of the assets, right? So those are the assets before accounting for that 100% bonus depreciation. Those elements are relevant because when John computes his QBI deduction, those are going to be important to determine if there's any phase outs. All right, now on the basis worksheet. So this is really important. These aren't necessarily filed with the tax return, but a partner should be tracking these because that will determine whether they can deduct the losses passing through to them. So remember, a partner's basis in the partnership is their share of their capital account at the end of the year plus their allocation of partnership debts. So when we look at John's increases to his basis increased by his $10,000 capital contribution during the year. His increased by the allocation of interest and dividend income, and then his increase in his share of partnership liabilities, right? So the amount of liabilities he had at the end of the year were $31,670. So $41,695 are the total increases to his basis during the year. Now, what decreases basis? Well, his allocation of the non-deductible expense and his allocation of the ordinary losses from line 1 of his K1. Now, when we factor those in, notice his basis is still positive, right? It's still a positive $13,240. And so kind of a quick way to do like a quick check of that, the $13,240, again, it's a combination of his debt basis and his capital account at the end of the year. So if we pull up a calculator here, right, it's $400 plus $31,270, right? So that's the $31,670 an increase. And then we take into account his negative capital account. There's the $13,240. So that's his total basis, accounting for the negative capital account plus the allocation of debts. Right. Now, again, the reason why that's important is because when John reports all this information on his return, if he has allocations of losses in excess of his basis, he generally cannot take those deductions. They're suspended losses. If he's allocated distributions, so if he took cash distributions in excess of basis, there might be a capital gain inclusion. Right. So that's why these basis worksheets are very, very important for the partners. And if this was an S corp, very important for S corps as well. All right. Now, I think two more things to cover, right? The Schedule K2 and K3 issues, and then the de minimis safe harbor election, right? So Schedule K3 and K2, if we look at K2 here for the international items, right? Line 16, attach K2, Form 1065, and the checkbox to indicate you are reporting items of international tax relevance. Now, in our case, we are taking the position that we qualify for the domestic filing exclusion. So we don't have to do K2 and K3. If that's the case and you qualify, you can enter qualify for exception to filing. And then you also have to include a statement with the K1s notifying the partner to that effect. So when we look at John's K1 here, we have an additional statement attached. This is sent to John, right? So this language that says the partnership met the conditions for 2022, exempting it from filing K3 and K2. And it's because criteria 1, the partnership had no or limited foreign activity. And that's true, right? We have a purely domestic business. We didn't do any international sales. We don't have any international contractors, nothing like that. And then criteria 2, each of the partners is a U.S. citizen, resident alien, or domestic trust. Now, even though you provide this notification to the partners that you're claiming the exclusion, you think you qualify, the partner now is on notice and can request the information otherwise. So John could make a request for a Schedule A K3, and there's certain timing restrictions on when he can do that. Again, I have another video that covers those issues in more detail. I'll put that in a link below, but go check that out if you think that you might have a K2 or K3 filing obligation. All right, so the last item I want to touch on is the de minimis safe harbor election. So when we look at if we go look at our financial statements again, so we have a variety of expenses here, computer equipment, some tools and other equipment. When you purchase assets that generally have a longer useful life beyond a year, arguably you should be capitalizing these costs and depreciating them. However, if the asset purchases are small enough in dollar amounts, you might qualify for the de minimis safe harbor election under 263A-1F, right? Now, in order to just deduct these costs, right, on your return, you can deduct them as ordinary trade or business costs, right? And so that's what we've done on page 1, is we've included those small tools and equipment and repairs expenses on line 20 for other deductions. But if you want to do that, you also have to include an election statement, right, which is the de minimis safe harbor election. So you have to file a statement that says the taxpayer is making this de minimis safe harbor election under Treasury Reg Section 1.263A-1F, right? So if you decide that you're going to deduct those costs currently, make sure you attach the election statement. All right, so I think that covers it for this video. I hope that was helpful, quite comprehensive, at least I think it was. So, if you have any questions, obviously feel free to leave a comment below. Happy to answer questions I can. And as always, I look forward to seeing you again on the next video. Thank you and take care.